So if you engage gold and silver again on their quarterly momentum, which we think was likely to happen in this next quarter, I think the speed at which that move occurs, the dynamics of it, will be jaw-dropping because it will not be in isolation. It will be in sync with a degradation, a cracking of the monster that they've created in the stock market and corporate debt market, in which case monetary panic will ensue. And that's what gold lives for.
This week's specials with Miles Franklin Precious Metal Investments. 2022 Silver Austrian Philharmonics for only $375 over spot at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Good to be back. Happy holiday.
Yeah, definitely. Happy holidays. Merry Christmas. And yeah, what I first wanted to discuss today was kind of, if we look back at our last interview, you were talking about how gold looked like it was on the cusp of a breakout. We definitely did see that run up in gold, but now we saw a pullback about to where we were last time, around the 1800 level. Your perspective on where gold and silver stand today? Well,
in November, we did have a run up in gold. And the run up in gold looked good to us because it crossed certain technical levels, momentum-based levels, not just price chart, that said, hey, it's trying to re-engage out of this congestion zone that it's been stuck in since it made its high in the summer of 2020. You know, it had gone from 2,070 intraday high all the way down to 1,673 from August last year to March of this year. It's a 20% drop. And then it's since gone into a range where basically after you had a rally in May, after that March low, you went from under 1,700 up to 1,900, and then you went into a range either side of 1,800, really, if you just look at it, up, down, up, down. During that run up in gold in November, we crossed certain numbers, but we also had a caveat, and the caveat was we want to see silver agree with gold. And we defined a number on silver that we wanted to see it close a week out at. And that was above its three-quarter moving average. Now, most people don't use that kind of average because it's a big old clumsy average. It doesn't change once every quarter, you know, instead of like a 200-day. It got up to a high weekly close in November, 1.5 cents below our number, and didn't close over it, and then fell. So silver went right up to the starting gate and said, I'm not joining in. Not yet. Okay. And so they both fell back down. Now, what's going on in gold and silver, if you think fundamentally, aside from the technical noise? It really is noise. Gold's been, you know, mid to upper 1800s, lower 1700s repeatedly following that March low, which has not been taken out since March low of this year. Just noise. It's like, you know, who's in charge here? Ever since mid-June, which is when the Fed first had those minutes that came out after their meeting that announced the good possibility that they were going to shift policy. They used the word taper. That has spooked the gold bugs intensely. And there have been at least 4 sell-offs that I can identify that are of the $100 nature since that mid-June break, counting that one, where you get the sell-off based on, oh, gosh, the Fed's going to tighten money. They're no longer going to have inflation, et cetera. Dream on. Okay. And gold will drop $100. Next thing you know, it's corked back up. And so the people who sold that sell-off, they're back to even again. They're not making any money. Okay. It's just noise. How come gold's not collapsing? I mean, if the Fed's going to end the game, right? You know, that's what they said. We're going to end this. We're going to stop this inflation. Well, gold is probably the smartest market on the planet. It's been around longer than any of the other markets for trading dollar indexes, cryptos, S&P 500. Been around thousands of years. And it is always protected against the decay in government-issued money units. You know, it's fiat money. if you overlay a chart of gold, go back 50 years and get an M2 chart from the St. Louis Federal Reserve, just overlay it on a gold chart, you'll see that's what gold is paying most attention to, is the continual degradation in money. It is not waiting for other things to tell it what to do. There's a couple good examples, and this is a broad thing. We're not talking micro right now. Think about the correlation people think there must be between the dollar negatively and gold. If the dollar is strong, gold must go down, et cetera, et cetera. Well, that's not a good correlation. If you go back and look at it, it doesn't hold up well, because the dollar really is only one of several major fiat developed market economy currencies. It's not the only one that's degrading rapidly. So is the euro, so is the yen, and others. So gold is looking at all of them. It's not just looking at the dollar. Okay. If you look at a dollar index and go back to 2015, now what happened in 2015? Gold had collapsed from 1900 level down to 1050 level. Okay, big collapse. So in late 2015, gold had been cut in half almost, and the dollar had a rally. That happened to be inverse at that point, actually. The dollar had rallied from 2012 to 15. But then in 2015, if you'll just get a chart of the dollar index, go to your computer screen, find a monthly bar chart of the dollar index from 2015 to the present, you could draw a line straight across the screen at about the current price level, 95, 96 on the dollar index, where the action for the last 6 years has been 5-6 points above there and 5-6 points below there. We're smack in the middle of a nothing, one of the most dormant, narrow percentage range in dollar index history, and yet gold doubled during that time. So it wasn't the dollar that caused gold to double in price. Okay, and where's gold right now? It's trading around 1,800. What? That's 1% or so below the high close in 2011. So it's not like it's collapsing. Okay, so that's against the dollar index. Now, how about commodities? There's recently been a comment about, gee, how come gold isn't reflecting the commodity price inflation? Commodities have exploded since late last year. For instance, the Bloomberg Commodity Index went from just above 50 up to 105. And our Momentum Structural Analysis put out a report last September 2020 saying there was going to be a commodity explosion. Well, there was. It doubled in price. How come gold didn't go up? Well, gold had already doubled in price. From 2015 to 2020, it had already doubled way before commodities ever thought about waking up. And if you look at the price chart of the Bloomberg Commodity Index, for example, its high in 2011, back when gold was 1900, was at 170. Bloomberg Commodity Index right now is trading either side of 100. So yes, it's doubled in price last year's low in the Bloomberg, but it's still nowhere near the 2011 high that it made. So gold is still way out in front of commodities. So what I'm suggesting to investors is quit this micro inverse relationship or coincident relationship to certain other asset categories. Gold is ahead of reality. It knows what's coming. And I think it knows what's coming now. And I think last Wednesday was a very interesting situation, because here we yet had another Fed meeting. They came out, and now they didn't just say we might do it. They said we're going to do it. We're going to have 3 rate rises. We're engaged. Okay, so what might have been since June is now reality. Okay, so it's no longer if, it's now real. Okay, let's say it's real. Well, how come gold, which had been under pressure since the November high, up in the upper 1800s, dropped down into the 1760s? This is all prior to that Fed meeting a week ago. Okay. In the hour that minute was released, the minutes were released saying that we're going to do this. Okay, hard fact. Gold sellers came in and added a bit more to the downside. They busted through price lows that gold had seen for the last 9 weeks, all in the 1760s, and they punched down to about 1750. In other words, they ran a bunch of stops. Within minutes, gold flipped, was well back up in the range that it had been for the prior weeks, and within a couple days, it rallied $60. Okay, like, Who cares what you guys say you're going to do? Okay. Now look at the S&P at the same time. When the minutes were released on midday Wednesday, the S&P shot up strong on Wednesday's close, and by Thursday morning's opening, about 5 or 6 hours of trading after the Fed meeting, made an all-time new S&P high. By Friday of last week, the S&P had collapsed and taken out 9 days of prior lows. Whoosh, back down. So in other words, we had investors responding positively to the S&P, negatively to gold, and both of them got banged. They were wrong. They either sold the news on gold or they bought the news on the S&P. What we think the big issue now is for gold is this. For 13 years since 2009, the Fed has done what? They've done everything they possibly can, QEs out the yin-yang, all kinds of policy moves to support asset categories that they deem to be essential. That would be the stock market, corporate debt market, primarily. And they've driven the stock market from levels, if get a chart of the S&P, go back to 2000, monthly chart. You can get them on your screen. And look at the 2000 bull market peak and then the, quote, big bear market that followed, the dot-com, okay, 2002. Then you had another bull market peak at about the same level in 2007. You had another big down in 2009. And then you had this 13 years of upside. When you look at the three bull markets, the 2000 peak, the 2007 peak, and where we are now, there's no comparison. The current move is the biggest bubble in U.S. stock market history, and it's also the most protracted, 13 years. And the Fed thinks they can come in now and prick that bubble. Of course, that's not their intent. Their intent is to change policy, but if they change policy, that bubble is technically ripe to break by our metrics. And if you break that bubble, they're going to have problems like they have never seen before. 2009 will look like a joke, like the minuscule thing that it appears to be when you look at that price chart I just mentioned. When you look at that 2000, 2002 bear market, 2007 to 9, it hardly shows up on the chart compared to what we've just done on the upside and what might occur on the downside if this bubble breaks. You cannot take away the central bank impetus that's driven all these developed economy stock markets. If you take it away, you're going to have a disaster. The Fed won't admit that. Instead, they're quoting other metrics, unemployment and this, that, or the other, or to commodity prices rising. But they know in their heart and the back of their mind that they cannot allow those asset classes to turn into broken bubbles. Now, one other one I mentioned was corporate debt. There's a couple of ETFs on that. There's JNK and HYG, trade on the U.S. exchanges, of high yield corporate debt. You get good interest rates when you can't get it elsewhere, you go there. Those ETFs made new lows for the year several weeks ago. Stock market didn't, but high yield debt made new lows for the year. Now, you can't have these asset categories start to crumble. If they do, the Fed's going to have to do some schizophrenic act. They're going to have, I don't know how they're possibly going to phrase it even after what they've just done. How can they reverse what they just did? It's an academic, intellectual panic for them. And it will happen because the technicals, as we read them in these asset categories, are highly vulnerable. And they're starting to express that vulnerability. You're seeing it in the action the last week or two. Erratic, fumbling action. We think we're only a few percentage points in major indexes above starting to break this stuff. And then it's going to be interesting. So now that maybe explains why gold said, okay, you're really actually going to do it, right? That's what they said. We don't care. Cork back up again. So I think you've got to think about these things when you watch gold instead of, do this day-to-day comparison stuff. I think gold is a smart market, and it knows that if the central banks sense that they've lost their asset bubble that they created, they're going to have to do something dramatic that we've probably never seen before.
You mentioned how gold is really the smartest market out there. It's been around for the longest time. It's been around for pretty much all of history. And that right now it seems like gold is signaling something. When we saw the Fed announce pretty much double taper this last Wednesday, gold popped. Gold went up, which seems completely counterintuitive, but it's signaling something. You're saying, if I'm hearing you right, that the Fed is going to have to reverse course dramatically.
Once these dominoes start to topple, this domino structure that they built, this huge bubble, beyond any bubble I've ever seen in the U.S. stock market history. And we know the policies that undergirded this thing. You can't say, oh, it was a strong economy. Get a chart from the St. Louis Fed called Fed Funds Rate. You can download it and look at it. You don't have to print it. See 50 years of that and see where we were in 2009 on that Fed Funds Rate chart, just above zero. Never in history has it been that low. 50 years to look back. It popped back up a couple percent during that time and then back down again to the mat. We've had 13 years of rates of the cost of money defined by the state, not by market forces, but by intellectuals with power who tell us money's free. It's free in Japan, free in Europe. Okay, what does that do to reality of individuals, families, corporations, even governments, state governments that are planning budgets? When you have a major factor in your thought process, in your planning process, the cost of money, priced effectively at zero, and you base decisions upon that, long duration decisions based on the assumption that the price of money will stay low or anywhere near that low, that's like building a bridge, with quicksand pillars. I mean, it cannot sustain, and therefore many errors have been committed. The errors micro errors, millions of micro errors in the economy. And when they come undone based on, it's like being given drugs for 13 years. You make a lot of bad decisions, okay? And you got to think about it. Money is the most essential commodity out there. It's the interstitching of society. It's the way human beings interact. It's not an evil thing. I don't know a gentleman in Hong Kong or in China or in Europe who may make a product that I really kind of like. And rather than patting him on the back and saying, hey, that's good, I like that, I buy it from him. And I buy it with a unit of money. It's my way of saying, thank you, I like what you just did. And if that thing I'm giving him is degrading in value so rapidly that he has to immediately go hedge it, it sort of decays social order. And they don't think about this. I think gold does. Now, on the issue of silver, we're looking for silver to agree with gold in the next upturn. I said it was a 3/4 moving average we're using as our metric. And as it happens in the case of silver, the trigger number is exactly at the 3/4 average. In case of gold, it wasn't. So as we plot our momentum charts, we have a structure, a resistance line that stopped that last rally precisely at the 3/4 average, or on the oscillator at our zero line. And we backed off again. Well, that zero line is going to adjust down in a couple weeks when the new quarter rolls around, because we're going to adjust down our new 3/4 moving average by about $1. So silver last time, which failed up there at 2534.6, was the actual peak close on that week. It failed just below the quarterly average. You get back up to about 2430 on any weekly close in the new quarter, and I'm going to break through. And at that point, silver's going to say, I'm with you, gold, let's go. And I think that's what we're looking for. We're looking for the coincidence of agreement between the two monetary metals. And I think we'll get it. And do I think we're going to get the signal? Yeah, I think we're going to get it. I think they had their litmus test here last week. All the thought about maybe, now it's real, okay? Okay, gold should collapse then, right? It didn't. So I think the bears have had their fourth javelin throw trying to kill gold, and it just didn't work.
Now, Ryan is wanting to know about your outlook then for this next year. It sounds like it's pretty positive for gold and silver, and you're not seeing another 12 months of consolidation?
No, I don't think so. I think if You got to watch the stock market most above and beyond gold. If you want to watch a market that will affect gold, watch the stock market. Now, I know there's a lot of gold bugs out there who think, oh, because of what happened in March of 2020, when there was a very brief several-day drop in the gold miners in silver and gold, coincident with the final days of that collapse that had already been going on for a couple of months in the S&P, they think, oh, gold is correlated to stocks. And also they remember October of 2008, when the stock market had already been going down for a full year from a peak in October 2007, stock market now. In October 2008, a year after its high, gold finally said, oh, I'm going to join in. And in a matter of 1 month, gold went from the 900s down into the high 600s, joined stocks for that 1 month, turned around and was back at its highs by the spring of the next year, 2009. Where was the S&P in 2009? Still making new lows. So yes, there was a 1 month correlation there between the sharp weakness in the stock market then and also in late March 2020. But those are about the only two linkages, if you go back through about 50 years of history of the S&P and gold, where there's a linkage, you could say, oh, I see a linkage. Quit it. The big linkages aren't there. And right now, I think gold is digesting the distinct possibility that we're headed for a bear market in stocks, which will panic the central banks off the page. Because they'll have a good excuse. They have Omicron now. You know, that's a good excuse. Okay, we'll print again because of that. The real reason is corporate debt is in trouble. And if the stock market gets into technical trouble, and I don't mean a crash, I mean just gets to a point where there's doubt and the confidence wanes quickly. We know there's a lot of very large asset managers out there who've already expressed sober skepticism about the stock market's pricing and sustainability based on variables that we're not even talking about, things that matter to them. And so we know there's a lot of major asset managers who are skeptical and are looking for alternative places to go. And a lot of them have moved into commodity-based stocks and have made good money the last year. We particularly advised buying fertilizer stocks a year ago. They've tripled. Oil stocks, yeah, they're struggling right now, but they doubled. Okay, so a lot of asset managers have already made that shift inside the stock market, but they're also looking at gold and gold related. And I think that's where you're going to see a lot of the money flow is into gold and gold related. And they're certainly cheap based on any metric you want to measure them against, especially gold miners and silver miners. So if you engage gold and silver again on their quarterly momentum, which we think was likely to happen in this next quarter, I think the speed at which that move occurs, the dynamics of it, will be jaw-dropping because it will not be in isolation. It will be in sync with a degradation, a cracking of the monster that they've created in the stock market and corporate debt market, in which case monetary panic will ensue. And that's what gold lives for.
Right. And if we do see this downturn in the stock market, that's just going to impact then the Federal Reserve to increase quantitative easing, reverse, and that's just even more bullish for gold.
I don't know how they're going to phrase it. In fact, what the worst thing that could happen from their point of view is because they just shifted, especially the Fed, not so much the ECB or the BOJ, okay, but especially because they've so convincingly shifted, it's going to be so hard for them to fumble their way back into a defensive position and explain it to the public and to the financial markets, except to say, oh my gosh, these assets are in trouble. They can't admit that. So that might create a delay in their actions, which might make it worse for the stock market if they don't hasten a reversal back into massively easy money again. So they're in a predicament that is almost laughable. And because of their intellectual view that it's either the only issue is how much money we're going to print and how cheap are we going to make money other than where it really ought to be. Those are their only debates. And so they're caught in a quagmire. And it's going to be fun to watch that issue just alone like watching Monty Python's Flying Circus. Okay. Anyway, it's going to be interesting. But watch the stock market, because if it reaches a point on the downside where you start to hear asset managers express public doubt, you can be sure that the Federal Reserve and their trading desks will be feeling the same thing.
It seems like in this situation, people will rush towards monetary metals for protection, gold and silver. Can you give us an update also on platinum? Many people have different perspectives on that, seeing it's as very undervalued right now, but others saying, it's not a monetary metal, so it's not going to perform the same.
We just did a report on it, in fact, this weekend. And my opinion of platinum is basically treated as another commodity within the commodity complex. Don't treat it as a monetary metal. It is nowhere near its 2011 high. Gold is trading either side of its 2011 high. Remember, the high close 1825.50, I think, was the peak close in 2011. Platinum's not even halfway back to that high. Or maybe I'm a little wrong. I think maybe it was 1700, and platinum's about 900 right now. So, it's pathetic. There's no comparison. And the technicals for platinum, while they look reasonably positive and coincident with the basic look of what the Bloomberg Commodity Index looks like, it looks like it's just part of the package. One other metal I wouldn't trust is palladium. The palladium is, they were unified together, palladium and platinum, and palladium took off because of the catalytic converter usage, which is, I think, 80% of the use of palladium is catalytic converters. Well, so if the greenies ever get their electric cars, I guess that might hurt palladium a bit, the lack of catalytic converters. But palladium had a huge blow-off move and a collapse, and then another move to a marginal new high, and it collapsed again. It's like palladium sort of off the page. Platinum, though, looks like basically just you throw a dart. It's just another commodity. It's not better than corn. No, in fact, it's not as good looking as corn, to tell you the truth, in terms of the commodity performance. So, yeah, I think it's a positive situation. It's likely to go up, but I don't think it's anything going to rival gold whatsoever.
All right. Well, Michael Oliver, we really appreciate your time today and all your insights. Before we let you go, where can our viewers find you? And did you want to share any last thoughts you had?
Well, our website is www.olivermsa, standing for Momentum Structural Analysis.com. And please go there and check it out. We explain our methodology. We have some sample reports, and you can email us and ask for some samples. We've got various products, including a Bitcoin product now. Oh, that's the last comment I'll make, too. Bitcoin. There's a lot of people who've discovered cryptocurrencies, which is a private money, okay? And it does have a virtue. And the virtue is it's not infinitely expandable like fiat currencies are. You can't hyperinflate a crypto because of the nature of the cryptos themselves. We've measured Bitcoin relative to gold going back to 2016, which is before it even became a futures contract in late 2017, Bitcoin futures. And we measure it week to week, its relative performance to gold, because we've heard a lot of ads on TV about Bitcoin is beating gold, et cetera, et cetera. Well, it's true. Especially since 2018, there have been three major up waves in the performance of Bitcoin, where if you plot Bitcoin versus gold, it outperforms, it pulls back, it outperforms again, pulls back. But it's created a trend structure. The spread chart has, the relative performance chart. And we run a momentum study of it. Last week's close on Bitcoin, and we know Bitcoin has dropped some recently, which we tend to expect, caused that relative performance chart to break a 3-year uptrend line in its relationship to gold. So MSA now argues that those who believe that cryptos are going to beat gold are probably wrong at this point. Yes, they have beaten gold for 3 years with violent up and down swings, but we think that trend has changed, and we think gold is now shifted to an outperformer versus Bitcoin, and likely will hold that status for many quarters, if not several years. That happens. We like the fact that happened because often spread changes or relative performance changes, when you measure them technically, will tend to somewhat coincide with net trend changes as well. In this case, we think that the potential upside in gold and silver that we see pending, if you can cross these quarterly structures that we define in our reports on gold and silver, will be fairly coincident with this recent breakdown in Bitcoin versus gold, or the upturn in gold versus Bitcoin. So I think that's an interesting event that just occurred that people should be aware of, and that we've measured. I don't know anybody else has issued a report like that, but we think Bitcoin is now a loser to gold. Now, that doesn't mean Bitcoin is going to go down or collapse or anything like that. It just means it's no longer going to outperform gold going forward. That's our assessment.
Once again, thank you so much, and God bless.
Thank you, Elijah.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.